All right, well, we'll talk about birth today, and we'll definitely get into some more of that stuff. So, start off by just explaining what Grid is. Grid is a global real estate community built for by investors for investors. I run the Grid DELCO chapter. Um, Disclaimer: we're not gurus. We're just a group of real estate people doing real estate deals. I like real estate. I sell real estate. I buy real estate. I invest in real estate. I look for people that invest in real estate. I look for people that's buying and selling and investing in real estate. That's what I like to talk about. It drives my wife crazy, but it's my life now, right? So that's who I like to surround myself with. So mission is just to learn, to connect, learn from, and collaborate with like-minded people interested in building wealth and creating impact through real estate. I don't charge anything for these seminars. It's just to meet people that want to learn about investing in real estate. And eventually, like one of my current investor clients that I'm partnering with was a client that I met at my first one of these 4 years ago, right? And now he's looking to buy a building in Pittsburgh with me because that's where I'm investing. So like that's where I think a lot of these things go. It's eventually if we mesh and you use the knowledge I give to build up, someday we could partner on things, right? We welcome investors of all experience levels. It doesn't really matter if you're brand new, I had a guy here in December that syndicates and he has like 600 units and he was here teaching our class about that. And, that was awesome. And then, you have people that have 0, 1, 10, 60 or 70, a couple hundred. Like that's how you learn. You surround yourself with people that are just doing it at higher and higher levels. And even new people teach you stuff all the time. So, I have agents on my team that are learning stuff and they'll bring it to me like, oh, I've never heard of that. Like, let's see how that goes. I've done a ton of deals. I'm for the first time this month doing my first subject too, right? I've never done one of those before as an investor myself. I've kind of facilitated them, but I've never been the primary purchasing or taking it over, which it's a new experience for me. I'm seeing all the legal documents and that side of it, and it was really cool, and I've done like 1,000 real estate sales and hundreds of rentals, and I've never done one of these before. So I like that in this industry, you can learn something brand new every day, and like it's always new, you know. All right, so just to explain, my name is Will Holder. I run the William Holder Realty team. I run this group because I'm an investor. I like to teach people about investing in real estate. I got into real estate to be an investor. So in 2012, when I bought my first house, I was like, I really want to learn how to invest in real estate. So I went out and got a real estate license because I thought that's what you're supposed to do. And then I realized I needed money to buy real estate. So then I started selling real estate and just got really good at that, built my business and a team, and then got back into the investing part of it. And now here we are. I'm not really like a fake it till you make it person, so I had to go do it before I started teaching it. So I did it and I failed a lot and eventually got good at it. And I still fail, but I'm doing better now. Um, Essentially, like I said, what I like to accomplish with anyone that comes to these is just basically like what's up, man? Basically uh teach you as much as I can. Hopefully that leads to you making money. And eventually someday, maybe you'll bring me a deal. Maybe we'll do a deal together. Maybe that turns into something more than just knowledge, right? How can you connect with me? I will literally give you my cell phone number at 610-657-6215. I'm on at William Holder Realty Team, WilliamHolderRealtyTeam.com, Will at William Holder Realty Team. Pretty easy to get a hold of. The number, 610-657-6215. Yes. Yep. Will Holder, Holder. Yep. For sure. Yeah. So, like to do whenever we get started is kind of go around the room, just introduce ourselves, see who we are. It's just real quick, couple of minutes, answer some of these questions. So, um, maybe we'll start. Chris.
My name's Chris. Bought my first property last August, 2024. I'm going to buy another 2-unit here pretty soon. And hopefully start selling them as well. My name is Isson. I had a I don't know real estate, but I would like to don't real estate.
There you go.
Uh,
There you go. Yeah. There you go. Give out your info. Yeah. 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 Oh, absolutely. Go ahead. Yeah.
267. I said this thing.
No, no, no. This is I think you'll do this. Is good. Yeah. 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 Yeah.
CC1. Okay, and then that's the name, and then the phone number is 267 334 9418.
What's your tone? 1-8?
Yeah. And then Joel, real estate. I'm just here to see if I can pick up one or two things.
Awesome. Yeah. How long you been investing?
Like 6 or 7 years.
Oh, good. Awesome.
Bill, real estate investor. Just getting started into it. Just bought my first property about a month ago or so.
Second, right? Second.
Second,
Yeah.
had a property in the Poconos that was like an investment property, yep, as well. Yeah, so my first BRRRR, so I am into the all the good and the bad that comes with that.
Yeah.
Hi, my name is Montera. I have 2 jobs actually. I'm a recruiter for Rehab,
Okay.
but I also own a couple properties that I rent out. Just like I said earlier, I did sell my certifications to start open a daycare. Some building that's 4,000 foot or bigger. And they're gonna be a warehouse, open it floor. So I could turn upstairs if it's a rental units, and then the bottom can be for the daycare. I took off over 20 investment properties to daycare centers as Airbnb. And I like properties.
Nice.
Hello, I'm Girish here. I started coming here about 9 months ago. I had 0 properties then. Now I'm paying investor with his knowledge and guidance. And my goal is to get into commercial slowly. But yeah, that's a little thank you.
Awesome.
My name is Paul Porter. I have 2 properties with Will, both of them are BRRRRs, and itching for my next one, and hoping to meet guys like that.
Yeah. 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 Bob's my wife's uncle, by the way. And yeah, we have bought our first one in 2019 and just bought another one in Wallingford a couple years ago and looking for another one. So, and Beth is Jess from the neighborhood. That's her cousin, right? Yeah, 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 yeah. Okay. Important legal stuff. I'll make it quick. Don't sue me. Everything I'm teaching is free. Don't use it against me. Okay. All right. I do record this. I post it on my YouTube, so don't say anything you don't want to be heard online. Okay. Or in person. All right. So what is buy and hold? And just so you guys know, the format of this is I do the presentation that we prepared. It's not super long. It's usually 20, 25 minutes, 30 minutes. And then we kind of open it up, have an open discussion. I share with you some things I've learned over the last month since the last one of these. We talk to each other as a group and, go from there. All right. So, what is a buy and hold? Whether you uncover opportunities through prospecting, networking, or marketing, getting the phone to ring is a critical skill to become a successful real estate investor. You can find properties on the market. Absolutely. I found a lot on the market. Usually the best properties you find are off market, right? And this is why if a seller, as a real estate agent, if a seller ever came to me and said, what's the best way to sell my house? It's on the market, right? Selling your house off market isn't ever the best way because you don't truly know what the market for your house is, right? But if you're an investor and you're looking for a deal, finding a wholesaler or a property off market or posting on Facebook saying, I'm an investor looking for a property, you'll probably find a better deal. You will find a better deal than if that property was on the market because you don't have any competition, right? So becoming a successful real estate investor as you scale, you have to figure out funnels or ways to get deals to you that aren't just on the market. Okay, so a buy and hold refers to a property you purchase with the intent of owning for a long period of time versus a flip or rehab, which investors typically hold for 6 to 12 months or less, otherwise known as income property or rental property. What are the two benefits? What's the difference, right? A flip, it's quick income. You're not quick, but it's income, right? And you pay taxes on it when the minute you sell that property. All right, you owe the IRS money. Well, not the minute, but when you file your taxes, and most people don't put away for that and are shocked the next year when they get it. And you cannot do a 1031 exchange on a flip to defer that income. So you're going to pay capital gains taxes on that money. All right, and that could be 15%, it could be 35%, depending on your income bracket. That sucks. And in the beginning, I always thought I would never do flips because why would I want to do that? The reality is flips are a necessary evil. I now definitely recommend them. So if you're doing buy and holds, you have to find a way to continue funding your buy and holds, right? And even if you do perfect BRRRRs most of the time, you're going to run into issues. You're probably going to leave some money in one or two. You're probably going to have a tenant that holds over and you end up paying more money on a BRRRR or into a property that year than you wanted to, that you had the reserves for. So doing flips as a part of your business plan is not a bad idea. And look, the fact that you're making enough money to pay taxes on it is a good problem, right? Because a lot of people don't have that problem, and that's a bad thing. So my mindset on that has changed a lot over the years. If you're BRRRRing, I recommend doing a flip. If you can kind of get into the comfortable cadence of BRRRR flip, BRRRR flip, BRRRR flip, you're going to do much better than if you just try to keep doing BRRRRs. Okay. Unless you have a large bank account to work with, which in that case, I'm happy for you. Right. Is someone going to say something? Did I miss? No. Okay. All right. The considerations for buy and hold properties are different from those of a fix and flip, but several issues are the same. All right. So, how much free cash do you have to market, buy, renovate, hold, and rent the property? What is your long-term strategy for real estate investing income, cash flow, or both? What is your tolerance for risk? And what is your tolerance for dealing with rehabs, contractors, tenants, buyers, and agents? Listen, if you don't have the stomach for this, don't do it. It is really, 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 really hard, and you're going to hate yourself a lot of nights. And that's just the reality, right? And I'm never going to sugarcoat that for you. Like, there's going to be a lot of nights where you're like, what did I get myself into? Right. And that's investing. If you invest money in the stock market, that can fall apart, right? Like 2008 wasn't a great year, you know? Uh, Life happens. And if you're investing in the stock market, you're investing in businesses, and those businesses can fail. Now you can invest in a fund that has a bunch of business that diversifies the risk, which is the same as like a REIT, a real estate investment trust. If you're looking for less risk, you could find a very successful REIT and go put some money in that and be passive. But more risk, more reward, right? So if you're willing to do a BRRRR, if you're willing to do a flip, if you're willing to go all in and handle all of the aspects of this project, chances are you will make more money if you do it right. On your first one, you're probably going to lose money. You're probably going to lose a lot of money. So be prepared. And I tell everyone that you're getting lucky so far, but you never know. Not done yet. So if you're prepared for that and you go into it with that in mind, it's going to get really easy for you because you'll understand how to scale after the first one. I pretty much tell everyone your first one, you're paying for an education, right? Like your loss is essentially your college degree and how not to do a flip, right? So, or a BRRRR, right? So, and you're going to be dealing, especially if you're doing a BRRRR. And the reason the BRRRR to me is the hardest is because you're dealing with every aspect of investing, right? If you're a flipper, you're buying, you're renovating, and you're reselling. If you're a buy and hold landlord, you're literally just buying, like you're putting a down payment and you're renting it, right? If you're, but if you're a BRRRR person, you're buying, You're looking for a deal, you're buying the deal, you're renovating the deal, you're renting the deal, you're refinancing the deal, and you're dealing with a property manager. So you're hitting all of the aspects of every other version of investing in this one transaction. So you have to have all of the contacts in place or find them very quickly. You have to have the stomach for all of those sections of the investment, right? And that could be really tough. So the questions that go into it, where do you want to own and hold rental properties? How long do you intend on keeping a rental investment? How will you manage your first properties? Or how about 10, right? What rate of return do you want to get from, where do you get from other investments? And what rate of appreciation do you expect from real estate? Bunch of really, really important questions here. And these are things you have to know before you get into this, right? Where? When I started, I wanted to own properties around here. And then 2020 happened and nothing around here was affordable or made money anymore. And I can tell you very, very simple, quick math. If you're buying a property in Delaware County for more than $250,000, chances are it's going to be really, really hard, a single family, to make money on that property. All right. With today's interest rates and the property taxes here and the insurance here, if the property value is over 250, 300,000, your expenses are probably going to outweigh your rents, right? That's just a reality around here. Doesn't mean you can't find deals. It just means it's much, much harder and you're limited to where you can buy in Delaware County. It's literally Southeast Delaware County is all that's left. Like you got Upper Darby, Collingdale, Fallcroft, even Fallcroft's getting a little high in price. Eddystone, Linwood, like that's it. That's really pretty much where you can find houses. Chester, like those are the places you can find houses that might cash flow if you do a really good job on a single family. Haven't talked about multifamily yet, but multifamily, the taxes are insane. I don't know if anyone's looked at any multifamily in Delaware County recently, but like a 5 unit, you're paying $14,000 a year in taxes in kind of anywhere in Delaware County. So quickly, I realized I had to change my location. If you have more money for a down payment, if you have a longer term strategy, it might work for you. But if not, find somewhere else to exist. It doesn't have to be in Pennsylvania. It could be in the South. It could be in Florida and Texas right now, where properties are selling close to 30% less than they were selling for 3 or 4 years ago. Find the market that works for you, right? How long do you intend to keep a rental investment? And every year you basically buy your property back from yourself. So every year you don't sell it, you're choosing to own that property for the next year, right? So every year when you sit down and you do your taxes and you look at your plan for the next year, if you keep that property, that means you're now buying it for the next year, right? And you have to choose every year if that property is worth keeping. If you're sitting there and you've lost a couple $100s or a couple $1,000s, is that ever going to change? Are the rents ever going to catch up with this thing? I had a conversation with a couple that have a triplex in the city that they've had since 2018, and they bought it, and their first contractor screwed them, and the second contractor screwed them, and they finally got it up and running and have lost money every year owning it. And they were like, well, maybe some year it'll turn around. And we did the math, and it was like 7 years from now, you might start making money on this thing. To sell it, right? Stop the bleeding, get your money out, go do something else, right? And that's when you're looking at each property, you have to decide, does it make sense keeping this, or can I just take the equity out and go put it in the stock market and have an easier life, right? Could I do a 1031 exchange and buy something bigger and have an easier life, or buy something smaller and deal with the boot and maybe do a cost segregation and deal with, figure out a way to not pay the taxes on it. So I'll need tenant. How will you manage your first few properties? This became a big issue because as you get to a certain amount of doors, if you're still working, which most likely you will have to be for up to a certain amount of doors, who's doing all of that work? Like who's showing your properties? When there's issues, who's going to go fix them? When you have a couple, it's manageable, but when you get to 10, who's collecting the rents? Who's making sure everything's okay? So if from day one, you're not factoring in what property management's going to cost you, it's going to cost you when it's time to actually have that happen. And I have a lot of people, they're like, oh, this deal will work because I don't have to pay a property manager now. Well, that's now. What about 5 years from now when you have too many properties? If you factor in a property manager, do you then have to sell this property? Right. So plan for that. What rate of return do you get from other investments? Again, can you make more money in the stock market? Is it easier just to throw it in a savings account, right? Um, and or other business types. At what rate of appreciation do you expect from real estate? If you bought a house in 2019, congrats, you did really, really, really well. You did like 20% and then 10% and then 5% and then 3%. But you're back to regular rates of appreciation right now, which is anywhere between 1% and 3% in most markets. And if you're in anywhere outside of the Northeast of America and the Midwest, you're actually in negative appreciation. So, or depreciation, right? Like you're losing money because a lot of those markets are depressed right now, right? And you have to be okay with that too, because that will happen. So renovating buy and hold properties, when kind of what I said, we prefer lower middle market properties in neighborhoods, right? Very low end properties attract troublesome tenants, and often require more maintenance. High end properties are nearly impossible to find at the prices that support the rents. There's a rate of return that just doesn't make sense. So, if you're buying a $500,000 property in Media Borough, which isn't, I don't even know if it exists anymore, versus a $900,000 property in Mirror, the rents aren't going to be that different for those two properties. But the mortgage payment is going to be very different, right? So, and I'm talking about single family. Obviously, if you go multi, it's different. But so you really want to be careful with how high you go, and how low you go. When you get into like commercial properties, like apartment buildings, you use what's called a cap rate to figure out essentially if it's worth your money buying that property, right? Um, Cap rates are great because it gives you a comfortable area. If the cap rate's 5 or lower, it's probably a bad investment unless it's in, you know, a super high end area. Like if it's a CVS in Laguna Beach and you're getting 4% on it, great. Like it's probably a really good investment because it's going to appreciate strongly. It's never going to go out of business and your money's safe there, but you're going to spend a ton of money to buy that property. If it's 4% and it's a 10 unit in Chester, don't buy it. Like you're not making enough money to own it. But then if it's a 15% in Chester, it might be there's something too good about that deal. What's really going on there that they're making that much money on? All right. So you have to learn what are the market cap rates for each market and figure out if you want to take that risk or not. The more risk you take, the higher the rate better be. Like the higher the rate of return better be. And I'm buying stuff south of Pittsburgh right now, and it's rough, and I'm not buying anything under like an 11 cap or a 12 cap. And I understand the risk I'm taking, but I won't take the risk for less than that.
Can you explain what cap rates are?
Mhm. So it's essentially the price you're paying for the amount of money you cash flow on that property every year. Your net operating income, which is your rent minus all your expenses. So your net operating income, not your mortgage payment, all of your other expenses, taxes, property management, uh, landscaping, snow removal, insurance, everything but principal and interest. So your net operating income, and you divide that by the price you pay for the property. All right, and it gives you a percentage of what your return on that price is. So if it's at $100,000 property and you're making 10 grand, it's a 10% return every year, right? That's the problem though, is it doesn't account for your mortgage payment. So you might say, oh, I'm only paying 100 grand for this and I'm getting 10 grand a year. That's great. But when you go take a mortgage on it, that's $800 a month mortgage payment. Now you're making a lot less. You're really making $400 a year, right? So the cap rates can be deceiving. You have to look at after the cap. So after I clear that 10, what's my principal and interest payment?
Sure.
Okay. What's that?
Cash on cash.
Cash on cash. Yep. Yep. So, and this is something you learn the hard way, but when you're doing a BRRRR, you cannot make the house perfect. Okay. You just can't. You can't gut it, right? You cannot replace all the plumbing and the electrical and the windows and the roof and the HVAC and fix structural issues and put a beautiful kitchen in it. You can't, because again, you're shrinking that percentage of equity by spending too much on the property, right? So you have to pick the things that make sense. Fix what's broken, okay? These are not gut job renovations of kitchens and bathrooms. You're painting cabinets, you ever see those videos online? It's like making fun of landlords when they'll like throw paint over a hole in the wall and say it's fixed, like not that bad. Don't be that guy, but find ways to reuse what's there versus ripping out and starting over. Okay. So repaint the cabinets and change the countertops. Don't rip the cabinets out, right? Like if it's a bathroom, so like if you're familiar with Delaware County, most of the bathrooms around here have what's called a DELCO tile. It's like this, it's either a green and pink or a pink and white tile with one strip. And this tile is on plaster and it's so heavy to rip out. Your contractor like hates you after ripping the thing out. You probably ripped these out. Just reglaze it, right? Instead of doing that and starting over with the bathroom, reglaze the tile, put a new vanity and a toilet in, brand new bathroom, right? That tile is really, really good tile. It's been there for 60 years. It's not going anywhere. It's not broken. Most of it isn't usually. And it's really expensive to get rid of. Just the trash alone, getting rid of it is tough, right? So find creative ways to reuse spaces without full gut jobs. Okay. Um, so reuse appliances from other rehabs, like, do carpet and vinyl in most rooms, laminate countertops, white tile in the bathrooms, basically is what I just said. Repair rather than replace most fixtures and systems. Replace the main systems in your upfront expenses. So if that furnace is 20 years old and it's still running, I would still maybe consider replacing that as part of your upfront renovation. If the roof is 25 years old, but it's not leaking, I would consider replacing that, right? Because you have to remember if you're running a rental property the right way, you're putting away 5% for capital expenditures of your rent. So if that's $1,000 rent, that's only $50. How many $50 payments is it going to take for you to get a roof? A lot, right? How many $50 payments is it for you to get a furnace? A lot. So if you think that's going to break before you hit the threshold that you can pay for a new one, replace it upfront, refinance it, get it into your upfront expenses so that you're not worried about that happening to you 6 months in, a year in, 2 years in, right? But if it's a 15-year-old furnace that you think you got 10 years on it, all right, like if you're HVAC guys, like this thing's gonna run for a while if you change the filters and you service it, keep it. Okay. The only exception is if the place needs a full renovation anyway, then use nicer materials like granite, stainless steel, etc., as the price difference for the materials is low enough to pay for itself in higher rents. High-end properties are nearly impossible to find at prices that support the rent. So, if you buy a house in like a medium price market, let's say Interboro or Ridley, right? Is it worth, if it needs the work, to put some nicer finishes in it to get the rents up? Yes, right? Because chances are your tenant is going to be a C or a B tenant. They're going to have good credit. They're going to have the income to support that rent. They're going to pay up for a nicer space, right? So weigh the location with what you're willing to risk putting into the property. Any questions about anything so far? I'm just like going. No? All right.
How do you classify an A, B, C tenant? What's your criteria? Just in general?
It's not necessarily the tenant, it's the location of the property, right? So A would be high end, right? Like if these are I mean, I guess high end now is like over 750, even over $1 million, right? Maybe not that high, and then B is probably in that like 4 to 750 range, and C is like 250 to 400. I'm just thinking like local pricing wise, and then like under 200 is probably like the wherever you can get a property in that price range, kind of probably a good way to look at it. So understand, property managers will cost between 8 and 10% of the gross rent plus half to 1 month's rent at turnover. This is really important because this is where a lot of people miscalculate the cost of owning a rental property. A lot of the calculators tell you use whatever your property manager's percentage is to figure out what you're going to pay your property manager. It doesn't tell you to factor that 1 month rent you're going to pay the property manager. If you factor that 1 month rent, you're actually paying them closer to 17 or 18%, not 10%. So when you're running an evaluation on a BRRRR or a rental or a multifamily property, I use 18% for property management, right? Because it's not in the property manager's best interest to keep your tenant for more than a year, right? They make more money if that tenant leaves and they get an extra month of rent as part of their commission for that property for the year. Do all property managers operate that way? No, but if a tenant gives notice, are they going to fight really hard to keep that tenant? No, it's in their best interest to get the tenant out and get a rent's commission, right? So assume the worst, which is that you might have to put a new tenant in every year. So factor that into your numbers, right? PMs can handle market, credit and background checks, rent collections, repairs, and evictions. When you start working with property managers, your job becomes to manage your property managers. It's easier than managing your tenants because there's less of them, but it's still a job. And if you're like doing a bigger building, like I have a 11 unit in Clareton, PA that I'm talking to my property manager weekly right now. And I only hired the property manager that was willing to have that cadence with me until this property got up and running, because I know how much they have to do in that market, how many units had to be filled, how much work the building needed. So that's how much I'm talking to them. Eventually, when the building's fully stabilized and I feel comfortable, we might go to twice a month or once a month. But if you're just waiting and letting your property manager manage your property, you're going to show up one day and there's going to be vines all over the property and there's going to be moldy issues. They're not stopping by your property every day, right? What you're hiring a property manager to do is to put some separation between you and the tenant, but not between you and the building. Okay. It's still your asset. They're not going to manage it like it's their own. So there's still some hand holding there necessary. A good PM should send detailed monthly reports of income and expenses, keep rents at or just below market rates to encourage renewals and less vacancies, and always do credit and background checks. Never accept an excuse or a partial payment. It's just good practice. If you make exceptions, you're gonna pay for them. It's just the reality. You might get away with it once or twice, but that third time you'll get burned. So the other factor when it comes to the BRRRR is loan considerations, right? Most investment property loans require 25% equity on purchase price or appraised value. Up to 10 properties can be financed using conforming Fannie Mae loans. Conforming loan rentals must usually be owned personally, i.e. not in an LLC trust, etc. They look for 6 months principal and interest, tax, insurance, reserves, typically required for each separate rental property. And they usually do about a 70% LTV max on refinances. Now, this is if you're using conforming financing, meaning the property is in your name. And yes, they will allow you to have up to 10 of those loans, which includes your own property. So you can have your house and then 9 loans. However, you can then do a blanket mortgage and then start over. So it's not like you're maxed at the 10. There's a way to clump them and go. My question would be why anyone would want to put 10 properties in their own name. I don't know. Like just get an LLC, put it under commercial financing, get it out of your name. there's less risk. You don't have to worry about being sued personally if someone falls on your property. You usually would get a lower rate if it's in your name, but to me, the risk of the lawsuit is outweighs the getting a slightly lower rate, right? Yeah.
Question. So once you have 10 properties, instead you can have a blanket mortgage.
Mhm.
Just bundle them into one single mortgage.
Yeah.
Then you can just repeat it.
Yeah.
Okay.
Yeah.
Okay. DSCR, you can get to the DSCR loans, right?
Yeah.
Not dependent on just the properties.
Yeah. Yeah. You can still debt service. But again, I don't know why you would put properties in your name, that many at least, you know. If it was like a second home and you're trying to do like a 10% down and still Airbnb it, okay, there's some benefit to that. But putting it in your name, the other negative of putting it in your name is if you're doing a BRRRR and you're moving effectively and you're moving quickly, with conforming loans, most banks have what's called a seasoning period, which means you got to make 12 payments before they'll consider the new market value. With commercial lenders, a lot of commercial lenders, not all, some of the commercial lenders I have don't even have a seasoning period. So I could do a BRRRR in 2 months and go back to them and say, hey, it's worth 100 now. I paid 35 for it. Can I get my 70 back because I put 35 into fixing it? That's the speed you can work at when you go LLC or commercial loan based versus putting it in your own name. Right? Yeah.
So what you're saying is, I probably can't do a cash out refi on my property.
Until the 12th month.
I already hit the 12.
Yeah, you're good. Yeah. If there's equity.
Where's that home?
Well, that's if it's an investment property. Remember, you're supposed to be living in your investment property. So, right, right. So, yeah, it's different. This is if it's a true investment property, right? So, yeah, if you live there, you can go up to 95% loan to value on a conventional loan. Okay, so this is the big part of the present. That was just the presentation. Okay. The BRRRR. The reason I love the BRRRR is because, and BRRRR, if you don't know, buy, renovate, rent, refinance, repeat. And some people add in depreciate. If you're BRRRRing, you can scale your portfolio much quicker with less money because you're rinsing and repeating the money. The problem there is make sure you throw in some flips because that money you're rinsing and repeating tends to get slimmer and slimmer as you make mistakes or you leave too much money in each deal, right? The reason the BRRRR to me is like a snowball effect is that you start off with a twin or a row and you figure it out on that one. And then you do another one. And then maybe 6 months later or a year later, you do a duplex. And then maybe that one takes you 9 months. And then you do a quad. And then by year 3, you're doing like a 6 or a 7 unit building. And then maybe by year 5, you have 10 to 15 units, right? And it does take that long to amass unless you're working with a large amount of money. But year 5, the building you bought year 1 is worth a lot more than it was year 1. You've made money off of it. And the buildings you bought year 2 are worth a lot more than you bought them for in year 2. And by year 5 or 6, you start to think about, what if I clumped all of these properties, sold them, did a 1031 exchange, took all the equity out, and went and bought a bigger property where all of the doors are under one roof, right? Because now I'm looking at, well, I have these 4 or 5 properties. I got 5 roofs, 5 heaters. My single family, if that goes vacant, it's 100% vacant. My duplex, if one of them leaves, 50% vacant. If I put all these properties and I buy a 15 unit building and one person leaves, I'm still pretty good on that building, right? If the roof's going on to deal with one roof, one heater, depending on the building. So that's where it becomes fun because that's where you could start to actually play with the equity you've built, right? Maybe you clump them and you do a line of credit on the equity, and now you can accelerate your investments, right? You can start tweaking asset classes. So maybe you can get a little bit more risky and go commercial, right? Or maybe you bought 6 properties, and while they have a lot of equity, they don't cash flow a lot because the interest rates are high, the taxes were higher. You did a blanket mortgage and the bank made you put flood insurance on it. I'm talking from experience here. And now all of a sudden it's not as profitable as it was to begin with. And you don't like the number you're making every month because it's like kind of not worth it. But you have this large amount of equity. Well, you could sell it, do a 1031 exchange, and buy something cheaper, right? Now, 1031s are supposed to be for properties of equal or greater value. If you buy something cheaper, the IRS has the boot amount, which they'll make you pay taxes on. However, if you buy something cheaper and you do a cost segregation on that property year one, you can accelerate the taxes you would have written off on that property in year one and probably offset the boot amount. So now you have a property that maybe you went from 25 doors to 10 doors, but you're making $4,000 a month versus the $700 a month you were cash flowing before. And you're like, wait a minute, I'm making way more with way less doors because my down payment was higher, right? And then you still have that equity in that property that you can get a line of credit on or some sort of loan on. So the more of these you stack, even if they're not super profitable, but they're gaining equity, the better for you, right? It's going to be painful because there's going to be properties you buy that you make $50 a month on after everything. And you're like, this sucks. Like if something goes wrong, I'm coming out of pocket here. But the equity is building, right? And if you're being patient and you're spending your money right, and maybe you're doing a flip or two to add some reserves, managing it won't be as painful because when you're 5, 6, 7 years in, and that property now has $100,000 in equity, and you have 6 or 7 of them, and you're like, okay, I could buy something really powerful here. It changes, right? So the BRRRR strategy is a long play. It's not a short play. And it takes a ton of patience, and it takes pretty much all of your every peaceful bone in your body to make sure it works right. But if done right, it can scale you much quicker than if you were to just save up 25% and put it down on a fully fixed up property, and then wait another 5 years and save up 25% and put it down on a fully fixed up property. You'll never get to the same point as quickly, right? Okay. Questions?
So question on the BRRRR strategy and the BSCR loan.
Mhm.
So when you go to the bank for cash out refi.
Yep.
They would ask you how much you paid for the property and how much you spent on the renovation.
Mm-hmm.
So how do you prove them that you spent $30,000 or $40,000?
Have your
The receipts and everything.
contractor write up an invoice. Yeah. Yeah.
Thanks, sir.
Yeah.
Have appraisal done. It used to be under 75.
Yeah, but
the appraised value.
Yeah, after 12 months after seasoning, but it's fine, but it was before the seasoning period.
Now that's-
Who'd you go to?
Is the bank like mortgage?
Yeah, I use First Resource Bank in Wayne. They're a commercial lender. They don't have a seasoning period, and he barely asked me any questions. And like they have my yeah.
Didn't work out for me.
No?
Wait for 6 months. Yeah.
It depends on your experience.
Yeah, maybe it's because you're okay, yeah. There's another I guess you could get like a broker, but yeah.
It's the reason why that building a relationship with a bank
Yeah.
is important, and I'm specifically looking at credit.
Yeah. Yeah.
Credit unions are a lot more friendly.
Yeah. And they'll like I've gone to like the client appreciation dinner for First Resource Bank, and like the lending boards there, and they're like, oh, this is you meet the people that are actually approving your loan. It's not like Bank of America where some person in a different state that makes a lot more money and doesn't care. So yeah, building relationships with local banks is huge.
terms of interest rates, have you done anything recently this year?
I haven't refinanced anything this year. I know rates last time I talked were at like 6.875. Yeah.
Yeah,
Point today.
yeah,
It's not gonna reflect anything for a little while.
yeah. But it's still better than 8.25 from like 2 years ago, you know. But I think a lot of people are panicking because people that bought in like 21 or 20 and they did like 5-1 arms, they're gonna have to come up against a refi pretty soon. And they were getting 4% and they're jumping up to 6.875, and they didn't do a good job of raising the rents and appreciating the property, they're gonna be negative cash flow. And so pay attention for deals like that right now. Like there's a lot more desperate landlords out there. Look for people that bought 5 years ago, and there's a ton of them happening in the city. A lot of those guys that started building these these are like they bought like a couple row homes and they're putting like a 13-unit condo building. All of the funds are eating those up because they haven't been able to make their interest payments in a couple of years, and they didn't finish the project because of COVID delays. And there's a ton of those in the city right now. Like it's uh and they're not going to be cheap, but they're going to be cheaper than if you had to buy them or do it yourself, right? Um, so pay attention for that. Uh, so yeah, the rates, a few of the things, like you mentioned, rates went down recently. Um,
Yeah, it's good. I mean, yeah, 25 bits. It's not top, but well,
I think there was just saying like about
That's for days.
yeah, yeah. If you're buying, like my one lender reached out because my brother bought a duplex like a year ago, and I think he was paying 7.25, and he did um 203K, which is a conventional renovation or FHA renovation product that is really good if you buy right and you use it right, but it usually ends up being a mess because a lot of lenders like they push that like everyone should be able to do it, and it's really not for everyone. Yeah, like if you're a new, they've never done a renovation project, or you don't have a good contractor, or you're gonna run into problems. Like your contractor's gonna run out of money. They're gonna mess up the project. You're gonna be on contractor number two. You're gonna be like it's been I've had early in my career, I've seen it happen so many times that I just don't recommend 203Ks to people unless they have some sort of experience with a renovation project. So like my brother did one, and he had me to lean on, so he did one, and but his rate was 7.25. It's in his name. My lender reached out today and he's like, hey, I think if he's got like 70%, if he's got 30% equity, I could get him 5.875 right now. And like that's huge because he was already cash flowing. Now he's gonna really cash flow, right? But that's not a cash out. So like he's still leaving some money in it from when he bought it and everything like that. So got to be the right situation. Um, but if you're like someone like you that's a licensed contractor, that if you don't own a property yet, you do a 203K, I mean, you could do really well, because you could save yourself a lot of money on the work, right? Um, and that I like that product for the right person. If if you're starting from fresh and you're like, I don't own any properties, or I have the ability to do an FHA loan, you can get a 4 unit with an FHA loan, right? And turnkey. So you buy, a 4 unit, and I think FHA will lend up to like close to $1 million with, 4 unit properties, turnkey properties. Like you can buy a pretty nice building, live in a unit, rent out the other three, and live fairly rent free, or mortgage free. That's how I recommend a lot of people to get into investing. Start with something like that, like simple. It's already fixed up. You're just putting as little down as possible, 3.5%. Make sure the numbers make sense, and you kind of learn how to be a landlord by living in the building, so you get to see firsthand all the issues you could run into. That's like in my opinion, like easiest runway to get going on. I had an investor call me today, and actually this is a subject two that I'm currently doing. It's the first one I've ever done. It was a client of mine. She listed her property in Philadelphia. We couldn't sell it. We could sell it, but you'd have to give it away essentially at this point because there's so much inventory in a lot of these zip codes in Philly. And so it's a nice property. She bought another home, making the two payments is getting a little hard for her. And she doesn't want to be a landlord. She owes like 200 on it. It's really worth probably 280 in a good market, but the most she can offer she's getting are like 250, 260. So I asked her if she'd be open to subject to, meaning the mortgage gets put into a trust. I'm paying the mortgage. It gets transferred into this trust. I own the property. I take over the payments, the responsibility, and everything. But that mortgage stays there on her credit. So I'm still getting her rate. And she's essentially holding a second note, which is just my down payment. It's the equity that I would have had to put down to buy that house, right? So if I bought it for 250, I'd have to put 50 grand down to hold this $200,000 loan. Well, I'm saying to her, you let me keep paying that $200,000 loan in a trust, and I'll pay you a very minimal amount on this $50,000 amount you would have gotten if you sold the property, and I'll take it over. I'll rent it. I will manage the property. It's costing me nothing to buy because I'm not putting any money down, and um, basically getting a very easy rental property. And she's happy because she's getting her mortgage paid and she's getting a little bit of money extra. And eventually, when I sell the property or refinance or actually finish the purchase, she'll get paid out, right? Um, that you're getting a lot of those calls right now. A lot of investors are trying to do subject to right now. So as a realtor, I'm, getting calls on any of our listings that are sitting for more than a few weeks. People are like, will the seller do subject to? It's not for everyone. It's got to be the right situation. But if you can convince a seller to do something like that, basically hold the note, it's really good. Um, that's not an no, it's not an assignment. No, it's essentially like look at it if you didn't have a mortgage on that property, right? So let's say you're a retired landlord or a tired landlord, you've been doing this forever, you kind of mismanaged your property, you didn't raise the rents enough, you didn't keep up with it, and you own it free and clear. And you're like, I don't want to deal with this anymore. But the market dictates the property is worth 700,000. You want 900,000 for it, right? Well, you can get someone to buy that from you subject to for 900 if you hold the mortgage. You become the lender essentially. So you're not actually giving that person a $700,000 mortgage. You're just taking a payment from them for that amount, right? And you're now no longer the owner of the property. You're now the risk is if that person stops paying, you got to get your property back, right? But you're getting a really good price for it, and that person's willing to pay that price because they don't have to come up with the money or, get the credit check or any of that stuff. Um, the same idea applies if the person had a mortgage. So if they have a mortgage, you can take it over, but you have to put it in a trust. You can't ever let the bank know title transferred because that'll trigger a payback. The bank will call that loan back and say, hey, someone else took this. We need our money. And that's how you pull off a subject to.
Do you have to pay something to the trust?
I mean, yeah, you pay some fees to set up a trust with a lawyer, and there's like some closing costs, but it's not the same as like a 25% down payment, and all that. Um, and also I got her rate, which was like less than 3%.
And you,
Yeah, in that trust.
so refinance it even though you're still making payments on it?
Eventually, if I want to actually complete it, like I can't go take a second loan or anything on it, right? But eventually, if I want to complete the full thing and pull it in my name, then I would get a loan on it. You have to pay her off and everything. Yeah, yeah. It's a really cool concept, but it's not for everyone. The guy who called me today, he's doing it because he's been buying properties in Delaware County for like a few years now. He's mostly been buying in Sun Village over by Widener because he's doing student rentals. And with the rates going up and prices going up, he's having a harder and harder time finding deals that work. So now he's trying to see if there's any landlords that bought and have a lower rate and he can take them over, and smart. And then him and I kind of had a great conversation about what's happening down there with Widener and the potential for that dorm coming and why Widener is like offloading a bunch of their properties. And yeah.
Is that what you were talking to us about when we were looking in that area?
Yeah, I'm a little like I wouldn't buy there right now. I would, because those Widener rentals did really good for a long time, but um I have there's an investor that owns a large piece of land that's been trying to push through a large dorm for Widener and either sell the plans to Widener or complete it and sell the building to Widener. If they do that, a lot of those houses down there won't be necessary. And a lot of those kids their parents don't love them living in those houses, right? So you can get them into a dorm, you know. So Widener just sold like 15 of their units that some were vacant and not being taken care of, but some were rented. And you're like, are they trying to get funds to purchase this project, And I know it's a couple years to build, but that diminishes the value of the properties you have there if that goes up. So uh one thing I wanted to bring up was especially for people that are working full-time jobs, like really lean into AI to help you get properties. So like you could get an AI dialer to call all the probate and all the, different types of, uh, high equity houses. They're better than a regular person. Like, I'm sorry, but they just are. And because they're very good. It sounds like a person on the phone. And there's not a whole lot of emotion. There's no emotion to an AI. They don't care if they got hung up or cursed out. They're just going to keep calling. And if you don't have time to call people for pre-foreclosures or pre-probate or any of these lists, there are AI dialers you can use. You can also a lot of AI systems we're using to automate marketing for like just my real estate team. You could do that if you're trying to market for investment properties. There are AI softwares that will specifically learn the content you're putting out, what content does best, like what full marketing firms did. There's AI systems right now that will do this for you for like a couple bucks a month and promote the ones or push the ones that are doing the best. Like they'll do all of the homework for you. And like,
Names of those.
yeah,
Stuff.
yeah. I was writing down a bunch this morning because I was listening to one. So Motion AI is one that analyzes ads and like will show you how to retarget and use the ones that are correct. Um, uh, Perplexity AI will do marketing research for you. So instead of you like figuring out what the right marketing to use for your specific product or what you're trying to do, it'll literally do all that for you, like a full company would. Um, those are two that, if you're looking to market for investment properties, are probably two good platforms to start with. And these things are cheap, man. It's crazy. Like I have a page we just started called DELCO Insider, and it's like fully AI generated. Like I recorded myself talking once for like 30 minutes reading a book, and then a video of me talking. And now, like I have an assistant in the Philippines that'll go in, like look up stories for Delaware County, put it in Chat GPT and say, hey, give me like a 30 to 45-second clip explaining the story, then throw it into uh the one we use called HeyGen. It'll generate me, like my avatar, telling that story, and then they throw it in not CapCut, one of the um Yeah, and it makes a video, and like within 5 minutes, they have a video of me talking about that story. And like, it's not me. Within the next year, you're not gonna know the video you're watching is AI or not. Like the person on that video, it's already happening. Like, only like a few of my close friends were like, "This isn't you, is it?" And Hey Jen is the video. Um, yeah, Hey Jen is the video one, but like, I'll show you like
That's one of the videos.
so uh I sat in front of my phone camera and read a script for like a half hour. It was like a book I was reading, and it saved that, and it learned my emotions and everything. So I mean, and I was just kind of messing around with it because I heard of it and I thought, oh, this would be cool. And after I did it, I'm like, wait a minute, I don't have like I don't have to do anything with this page. Like I do nothing with this page. I don't know, it's not clear, but like, yeah, yeah. And this is done by a VA I have in the Philippines, and each one of these videos takes her 5 minutes. And like the agent I heard about this from, he's been doing it in Florida, and like within 3 months he had like uh 10,000 followers or something on a fully AI powered page that, you know, now my team stuff is me. Like the actual videos you see on like my team pages are me, but this is all AI. And like you're not gonna know, you're just not gonna know. So like um yeah, it's it's getting crazy. So use this stuff to I'm gonna end the Zoom here, but thanks for everyone that came on the Zoom. Hopefully you guys learned something.